battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show, episode 158, Sell Everything. It's not what you think it is, so don't go away. Don't hit sell yet. Just hearing the article, we got to get into the content of this week's show. But before we do, I just want to remind you that we do have Investor Day 2025 coming up very soon. It's this year, 2024, though. Make sure you get it on the calendar. And I will tell you, it is filling up very quickly. This is our flagship event. We do have Dr. Ed Yardeni coming in with the Yardeni Research, a legend on Wall Street. We have Andrew Opdyke, tremendous content. November 7th and 8th this year. It's literally 70% sold already. So the official invites are going out in the mail. I've been plugging it on the show every week. If you listen to the show and you're thinking you're going to come in, don't hesitate any longer, because I'm telling you, it's 70% full. And it probably will be full as soon as these invites go out here, probably next week, maybe the week after. So get on the invite. You don't want to miss this event, November 7th and 8th, Investor Day. We're going to tell you what we do with our rebalance process, how to think about investing right now, where we think markets are going in 2025. So don't miss this thing. Investor Day, you can register right there on the screen. I guess we can't put the registration link in the YouTube video, but just go to our website, StengerFamilyOffice.com, and go to Insights. There is a button for events, and then you can register through there. Otherwise, if you are on a computer and you can pull out your smartphone, take a picture of the QR code, register right now. Don't forget to do it. We will sell this thing out. We always do. It's a tremendous event. Can't wait to see you. All right, episode 158, Sell Everything. No, I'm not telling you to sell everything. I'm telling you what a client said to me last week after being in the market. This really has never happened to us before. We've been doing this a long time. Stenger Family Office has been around, and the Stenger Group and our firm, we've been advising clients for a very long time. We have never had somebody where they were in the market for a week and a half and they immediately wanted to sell out. And that's what happened to us. Literally, market went down 2%. It was that day the other week when I put out the market minute video and demanded that they be sold out of the market. And I said, don't do it. You're going to regret it. You're on a long-term plan. You got years to go before you're going to need to touch this money, and even longer than that after you retire to grow this to beat inflation. Well, they just couldn't stomach a 2% decline. I was kind of surprised by it. We did what they wanted to do, sold them out, and sure enough, the market's right back up to where it started. They actually would have been up 2% now. It was a 4% swing overall, and this is the saddest thing that we could possibly have happen. And this is what I try to tell you is don't try and time the market. If you're going to be a long-term investor, you got to stay in. You got to stomach the risk. You have to understand that stocks are volatile. And this person's particular comment to me was, well, Nick, on your last video, you said we're 4% of the way into what could be a 10% correction. And the answer, of course, is yes. We could always have a 10% correction. We get 10% corrections once a year. So yeah, are we due for a 10% correction? Probably. But you trying to time that is a losing strategy, because let's just say we don't have the 10% correction. Let's say you don't time it perfectly. Well, chances are you're going to sell out and you're going to buy back in when the market's even higher. You got to be right twice. You have to know when to get back in. And that's not what we do. We're not market timers. Stenger Family Office is not here to tell you when to get in, when to get out, when to know when to hold them and fold them, and when to walk away and when to run. That's not us. And if you're looking for a trader, you are in the wrong place. You need to go hire somebody else who's going to trade your money. We are not going to trade your money. We are going to be on a long-term diversified investment plan. So if you call and say, Nick, sell everything, first I will try and talk you off the ledge and try and say, maybe don't sell everything. Maybe stay on your plan, because you do need to beat inflation, and over the long run, stocks have the ability to go up. And we talk about in the stock market that stocks climb a wall of worry. Why is the stock market higher today than it's ever been? Why is the stock market higher today than it was at the peak of COVID? Why is it higher today than it was at the peak of 2021? Why is it higher today than it was at the peak of 08 and 09 and the tech bubble and all the other events that have happened? Simply because markets go up more than they go down. And on an annual basis, on a year-to-year basis, you literally have about a 56% chance your portfolio will actually be up just year to year. And if you drag that out to a 10-year rolling time frame, sometimes we do this trivia question at our events where we say in a 10-year rolling time frame, what's the probability that stocks produce a positive return? The answer is 100% of the time. So if you're going to be, even if you're 60 years old and you're looking at retiring, you're like, Nick, I got to be conservative. I'm worried about the sky falling. I'm worried about the doom and gloom. I am on the brink of filling a bunker with canned food, gold, guns, butter in my backyard. Uh, well, the question would be, are you going to live till 70? Because if you do live till 70, you should just be in the equity market. Now, that's not to say we don't have risk management. We, of course, have treasuries built in. We do have careful risk management. We have some cash on the sidelines. We have money for a rainy day. We have money to meet your distributions in retirement. And the stocks in the portfolio, everything else beyond what you need to meet maybe 3, 4, 5 years of living expenses is going to go into equities that can beat the rising cost of goods and services. So my response to this person who sold out after being in the market for a week is, I feel really bad for you, because chances are this individual will never return to the stock market, will never get back in. And if they do, they will buy in at higher prices than they sold out. And that's already the case. So don't try and time this thing. Don't try and panic. Don't try and worry about the election coming up. Geopolitics, Israel, Palestine, all these different things, Russia, Ukraine, all the geopolitics. Because if you focus on the nonsense, if you let the media get to you and make you scared about the future, you will miss the wonderful stories of what's going on underneath the surface. Entrepreneurs producing profit, innovating, creating extraordinary amounts of wealth for all the rest of us. And yes, you have the billionaires worth 100 billion or 200 billion or 300, whatever the most. I think Elon Musk is like 200 plus now in net worth. Think about all the net worth, though, that Elon Musk has created for us, that Jeff Bezos has created for us, for Bill Gates, and all these innovators, all these entrepreneurs. You don't have to like any of these people personally. We certainly don't agree with every single thing they do. I'm just saying, they're incredible innovators. They've created extraordinary amounts of wealth for us. And if we focus on the long run stories of innovation, of entrepreneurship, you will be just fine. Companies will produce more profits than ever before. It may take some time, but we are headed towards $315 in profits on the S&P. Let's just say we multiply that by a reasonable PE of 20. That's 6,300 points on the S&P. Now, does it happen in a year, 18 months, 2 years? Nobody knows. So we got the crystal ball. It's a little fuzzy. Not really sure exactly when we'll hit 6,300 on the S&P, but it's coming. It's going to happen. And so you trying to time and get in and get out and panic over little pullbacks, little corrections is such a bad move, because you're losing sight of the big picture. You're losing perspective. And so if you can't keep your perspective, if you're thinking maybe I will panic, depending on what happens this election season, for example, you got to call somebody. You got to call a good fiduciary financial advisor who will keep you on a plan. So we are not reactionary. We don't react to ups and downs in the market. We don't react to what is happening on a day-to-day basis. If there's a buying opportunity, like NVIDIA gets real cheap, yeah, we're going to add 1 or 2% to it. And that's exactly what we did this week in the portfolio. So yes, of course, we're going to be looking for great opportunities, but we're not going to react. We're going to be on a disciplined long-term plan. And that plan has got to be goals-based, not risk-based. It has to be a long-term view on what's to come. And what's to come is higher inflation, higher cost of goods and services. So when you see these corrections, Producer Owen, if you don't mind throwing the next chart up here on the screen for everybody, this is a chart of the S&P 500. I know it's a little hard to see. You're seeing that pullback just the past week or so, down about 3% from the all-time high. It's actually coming up a little bit more than that now, so not quite as bad if you update this chart to tomorrow. But the reality is these corrections, it's just a blip on the radar. We had one of these back in the earlier part of the year. We had a correction like this. We had a significant correction in 2023 that everybody forgot about. We had a significant correction, of course, in 2022, in the fall of 2022. That's when we came out with Bye Bye Baby and said, buy as much as you can. The stocks are cheap. And sure enough, that was correct. And of course, we had this in 2018. We had this during COVID. We had this during 2011. We had this, of course, in 08 and 09. And it's like Shelby Davis, the famous mutual fund manager, once said, you make most of your money in a bear market. You just don't know it at the time. And so don't take this little pullback, this little blip on the radar as the end of life as we know it. It's not. It's just a blip on the radar. And soon, as we zoom out from this chart, I know it's hard to believe, but 3, 4, 5 years down the road, you're not even going to remember this pullback happened. You're just going to be glad you stayed on your plan. Not stock advice, but let's go to the next chart. This is NVIDIA in particular. And this is, again, I'm not telling you to go buy NVIDIA. I'm not telling you it's the best buying opportunity of all time. I'm not telling you it's the best company of all time. I'm just giving you information to show you that NVIDIA is before this rally today was down about 22% from its all-time high. So what does that show you? It just shows you that the bigger the PE, the harder they can fall. So if you're going to be in U.S. equities, if you're going to be in technology, we like to have about 28% of technology, a little bit underweight. So you've got a ballast in the portfolio. You're not going to go down quite as much as the S&P in these downturns. If you're going to be in tech, though, which you have to be for long-term growth, you got to accept the fact that the bigger the PE, when you have a significant downturn, is going to just fall harder. And there have been times where NVIDIA, I think it's 3 times now, I can't remember the exact timeline, but it's been about 3 times where NVIDIA stock has been down 55%. It looks like the world is coming to an end, but it's not. It's just a correction. It's a pullback. And that's what investors do. They have to digest these pullbacks. And then all of a sudden the news changes and things get better and you're happy. You hopefully stayed the course and even bought more. You saw this with Meta in, I think it was 2022 when we had the big sell-off. Stock went from like 160, 170 roughly down to 90. And everybody said Meta was over. The PE ratio at the time was like 11 or 12. It was trading like a value stock. We did actually buy it for clients. And we said, this is the time to buy because this thing is dirt cheap. Stock rallied past 500. Now, I'm just giving you one example. Obviously, we haven't nailed every single call. We haven't had every single purchase work out. But I'm just giving you an example of there are buying opportunities like this, and you just have to stay on a disciplined plan. Where when the stock that you were in used to be a 2% weight in the portfolio, it drops to a 1% weight. Maybe you look at adding another 1%. You go back to your 2% weight. That's called rebalancing. And rebalancing is a really important part of being an investor. If you rebalance, you are constantly trimming some profit when you've done well. You're putting that profit back into the stuff that hasn't done as well. Over time, you're going to stay right in the middle of the road from a risk perspective. Rebalancing doesn't protect you against loss, but it really kind of balances things out, especially when you go through a downturn. It doesn't look like a good idea in a bull market. When you go through a bear market, you're going to be happy you rebalanced. And that's what we do for our retired clients. Think about if you've got 80% in equities and 20% in treasuries, or at least that's where you start out in retirement. Let's say equities have gone up a bunch. Well, let's take some profit because relatively speaking, our treasuries might have fallen from a 20% weight in the portfolio to 17 or 16. So we need to replenish a 4% weight in the portfolio back towards treasuries so that you get back on your usual goals-based plan. That's how we do rebalancing. So this is all math-driven. It's all principles-based. It's all consistent. It's all based on a plan, not based on emotion. And that is one of the biggest risks that we see with investing is people just get so emotional about the short term, they lose track of the long term. And that's what we want to try and do is help you stay on a long-term plan. So those are a couple of the big items to be thinking about here. I do want to just turn your attention to a few other major risks. We will come out with a video eventually, 10 mistakes that investors make. I want to highlight a couple of those. We may run out of time on this week's show, but one of them is confusing risk and volatility. This is one of the classic ways that people get goofed up on their financial plan is they think that the stock market going up and down or the ticker tape flying across the screen on CNBC is risk. And that's not risk, it's volatility. Risk is rather defined as you possibly running out of money while you're retired because of the rising cost of goods and services. Inflation is your risk, not stocks going up and down. Stocks going up and down, volatility will be with you as long as you're going to be an equity holder. So the reality is you have to redefine risk and volatility, and you have to get not on a risk-based financial plan that just starts with a risk-based questionnaire and says, how do you feel if the market goes down? Or, out of 1 to 10, how do you feel about risk today? Those surveys are sort of helpful, but not really helpful because we've done studies on this now and we've read a lot of these studies at least. And basically what they come out with is it's just what people feel like that day. So if the market's up a bunch and you ask people how they feel about risk, they're going to be like, yeah, I love risk. Risk is great. Give me more of it. If the market's down that day when they fill out the survey, what are they going to say? I hate risk. Don't give me any equities. I just want cash and bonds. They don't tell you anything about the actual trajectory of what we have to have in the plan or what the plan calls for from an investment standpoint. All they tell you is how somebody feels that day. So you can't start from a risk-based approach. You need to have a goals-based approach, which says, number one goal, we can't run out of money while you're retired. So if you're going to be around till you're 90, 95 even, people are living a lot longer than that too, here and there. We got to make sure you don't run out of money when you're 95 years old and have to go move in with your kids. Nobody wants that, including you and including your kids. And so the reality is we want to make sure that you can, number one, not run out of money. Number two, pay for whatever big expenses come up, maybe healthcare expenses, maybe a car, maybe Maybe there's a second home you want to buy. Maybe there's vacation. Maybe there's travel. There's a million things you can do with a goals-based plan. And then that tells us what we need to do with the investment. So you start with the financial plan, and then you can address that financial plan with the investments. And way too often, people start in reverse. They build the investment plan first and don't properly address their financial planning needs. So that's one of the big risks. Number two is just trying to time the market. I won't beat a dead horse on this one. We talked about this, but you trying to time the market is a terrible idea. If you try to do this over time, you are going to have worse returns than your friends and family and your neighbors who are working with a fiduciary advisor on a plan, because once in a while you might get it right, but you're probably going to miss the uptick when stocks do well. Nobody knows when stocks are going to do well down to a T. And I think stocks directionally the next 5, 10 years, 15 years will do well. But how can we possibly time that in a year where we have 252 trading days? It's just impossible. So the reality is you're going to be much better off just owning across all those different days, whether they're bad or good, holding, buying more when things get bad, rather than trying to time this and get in and get out. Number three is not having enough diversification. I see this all the time. People are heavy on one stock. What's the right amount of diversification is, to me, it's not having more than 10% in a company. We actually go a little bit lower than that. We're about 8% in one stock on the very upper end of our risk tolerance and our investment plans for people. You could even go 6, 7%. I think that's the right amount. Sectors, we really don't want to push much past 35% in a sector, but that's even high, like 30. I think 30 is pretty good. And you also don't want to get too out of whack with the general S&P. This is how people get in trouble a lot too, is they'll leverage up on oil stocks, for example, and the S&P may have a 8% weight in oil, for example, they'll go 20%. And so if you're out of that acceptable tracking error range, if you're out of that margin of error, you can get blown up when things don't work out for you. So that's why we try to keep you pretty much benchmarked to the S&P, give or take a few percentage points. The other thing that, and this is another risk, number 4, is actually too much diversification. Might sound kind of crazy or backwards to you. You think there's no such thing as too much diversification. There actually is, because there's just not that many companies out there that are worth buying, especially if you start running some basic screens. There's about 8,300 US publicly traded companies you can buy. Only 2,000 of them roughly are profitable. About 1,000 of them will remain profitable and grow those profits. And then the ones that could actually survive 08 and 09 and have a good balance sheet through the entire course, there's about 97. So it's really the top names in the S&P 100. That's not an exact rule. That's sort of the math of it. And so if you have too many companies, I've seen people come in with these portfolios where they have, first of all, a ton of overlap. They have like 12 different mutual funds all doing the same thing, or they have like 5,000 different stocks. It's impossible to track all this stuff. And so you can't have too much diversification too. Number 5 is leverage. Leverage makes things look really good when times are good, but when times are bad, it's like Warren Buffett said, rising tide lifts all boats. It's not until the tide goes out that you find out who's swimming naked. That's what leverage does to the portfolio. It makes returns look really good on the upside, but it can actually wipe you out on the downside. So we hate having leverage. We, of course, want you to be debt-free, as close to it as you can be when you're retired. We don't want you to use leverage with your investments. It's just a terrible idea. Number 6 is not enough of a safety net. Cash is king. And you'll learn this if you know any business owners and successful ones at that. They love having cash, and cash is king. So you got to have cash. You have to have money for a rainy day. You have to have treasuries. You don't want to have too much because that can drag down the return, but you do want to have enough to mitigate your risk. I would say for the next 4 or 5 years. I think that's plenty of cash. You still have your income coming in. You can go even a little bit lower. But as you get closer to retirement, that's the number we look at, is about 4 or 5 years in living expenses set aside. And then number 7, we'll quickly roll through a few of these other potential risks here for investors, is paying the wrong price for the right company. You can find the best company on earth, a company that's growing, it's profitable, great balance sheet. But if you go out and pay 200 times earnings for it, you're probably not going to get a return on the stock because you just bought the right company at the wrong price. And so we try to look at valuation metrics as well. And we don't want to have a portfolio of only value stocks because they don't grow as much. We want to look at a diversified portfolio of growth and value. But again, you just got to be careful with some of these names where they trade at a very, very high multiple. That's what happened in the tech bubble. Now, thankfully, the S&P is nowhere close to where it traded in the tech bubble. It's about half of the valuation that we had in 1999 leading up to the big pop and the burst. But now, some of these names, some of these runaway tech names, some of the meme stocks are coming back like they did in 2020, 2021. So just be aware of that. Don't overload on some of these names that the earnings can't support their valuations. Number 8 is forgetting to rebalance. We already talked about this, but just make sure you're rebalancing. Make sure you're staying on a discipline plan. That's the word I would use, is discipline. So you're not using emotion to figure out when to rebalance. You're just saying, hey, I rebalance annually. I rebalance semi-annually. I rebalance quarterly. And I don't think there's a right or wrong answer. Mathematically, quarterly does work if you don't have transaction costs, if you don't have tax issues and things like that. But even annually is fine. But just make sure you actually do it, and don't use any other outside factors to make that decision. Just make sure you actually do rebalance, and we do that for our clients, of course, in house. Number 9 is cookie cutter investments. That's where your investments don't actually match the financial plan. So you may be in a home office portfolio, is what it's called, where your advisor, for example, is not actually managing the money in-house. They've got it subbed out. It's actually subcontracted to a third party. And I found typically the quality is not very good. Sometimes you can find really good quality subcontractors in the asset management space that can do a great job for you. So there are names out there. I can tell you who the good ones are, but typically speaking, a lot of people are in these cookie cutter portfolios, and it's understandable. I mean, these companies have to scale across 1 million, 2 million clients, but there's really no customization done to your plan. So you want to ask the question, who's actually managing the money here? Is it my advisor, or is it this third party? Is it a target date fund that just has such a mismatch to my actual goals, my specific plan? And that is a huge deal. So make sure you're looking at who is managing the money. Make sure it matches your financial plan. Last but not least, emotional reactions to the market. And if you can get emotions out of investing, you will become a great investor. If you can put your worries aside, if you can put your fears aside, and you can just stay on a disciplined, goals-based plan with the help of a fiduciary advisor if you need it, you will do just fine. We will hopefully over the years see the stock market continue to go up. I think we're going to see great returns. There's no guarantees, of course, of what's to come, and past performance is not a guarantee of future results, but I do think we're going to do very well. The stock market, remember, is resilient, and it climbs a wall of worry. And over time, I think people are going to be extremely positively surprised at how well stocks do. And so if you can put these fears aside, it's okay to feel the fear. It's okay to be worried. It's okay to have concerns. We all have that, but you just don't want to act on it. And so if you have to pay an advisor 1% to keep you in and invest it across all these cycles and not make these big mistakes, it's worth every penny, quite frankly. If you are thinking, I am going to have a problem, or I'm worried about my family, if I'm not around having a problem, staying the course and having some guardrails around their plan, get a good advisor, whether it's us or somebody else. Just make sure you're working with somebody, because that 10% correction will come. Even if it's not this year, let's say it's next year or the year after, when it comes, you just need to make sure that you've got some people around you who can keep you on a disciplined, long-term, goals-based plan, not risk-based, but goals-based. So that's all I've got for you today. Thank you so much for being with us. Episode 158. Don't forget to register for Investor Day 2025, but it's this year. Remember, 2024, November 7th and 8th. It is 70% full. So get it on the calendar, reach out to Julie, or register online. And if you can, please subscribe to the YouTube channel or on Spotify or Apple, wherever you are listening. We so appreciate you coming back each and every week. We'll see you next time for episode 159.